Hello and welcome to the Q1 2026 review. Today I wanted to do a quick review of what happened in the markets during the first quarter of the year. But I also wanted to add an important caveat right from the start. Even as I'm recording this near the end of April, a lot of the downs that we saw during the first quarter have already reversed. And this has become a bit of a pattern over the last 10 years. Markets drop, people get nervous, headlines get loud, and then before long, a lot of that decline has already recovered. And that doesn't mean that markets only go up. It doesn't mean that downturns are not uncomfortable, it's not scary, but it does mean that reacting emotionally to short-term declines continues to be one of the biggest mistakes we can make investing. So with that said, let's get into the first quarter. By the end of the first quarter, the Canadian market was up about 4%, the US market was down about 2%, although that really hides the fact that there's been ups and then a significant pullback. International markets were flat at around 0.5%, and bonds, as you would expect, were less dramatic. So overall, it was a mixed quarter. Canada held up pretty well against the US, internationally did okay, and bonds were relatively steady. I do think the bigger lesson, though, is not that markets were messy. Markets are always like that. The real lesson is that short-term volatility and long-term outcomes are not the same thing. A drop in the market feels important in the moment, but very often, by the time people feel comfortable again, a lot of the recovery has already happened. And that's why discipline matters. That's why having a plan matters. And that's why reacting to every short-term move usually does way more harm than actual good. Now, the other thing I wanted to cover in this video is a comment that I made in a recent email about precious metals and commodities. I said that for most people, buying precious metals is speculative, and I got quite a bit of feedback on it. So I wanted to explain more clearly what I mean. A lot of commodity-related financial products were originally designed to manage risk, not to create wealth or invest in by themselves. For example, let's think of a farmer. If I'm a farmer and I expect to have 100 bushels of wheat for sale in the future, I have a real risk. The price of wheat could fall before I sell it. So I might use a financial contract to lock in a price today. That means I give up some of the upside, but I protect myself if prices fall. I have transferred some of that risk. That is a hedge. It's very similar to insurance. I'm not using that contract to get rich. I'm using it to reduce uncertainty. Now take a jeweler or even a science lab that regularly uses gold in its work. They may have real exposure to the price of gold. If the price of gold rises sharply, their costs go up. That often affects their margins, their pricing, and their operations. So they may use these contracts or other financial tools to lock in a price or reduce that risk ahead of time. Again, this is a hedge. They are not trying to make money from guessing where gold prices will go. They're trying to manage a very real risk that exists in their business or their lives. And this is a very key distinction. A hedge reduces an existing risk. A speculative trade adds a new risk. Now compare that to someone that doesn't farm wheat, doesn't make jewelry, doesn't run a science lab, doesn't have any underlying business exposure to commodities at all. But they decide to buy a commodity contract or buy because they think the price will go up or down. At that point, they are not reducing risk. They are taking on risk in the hope of making a profit. This is speculation. I think that's where a lot of the confusion comes from. People hear that gold can be a hedge or that commodities can protect during certain environments, and they jump from that to treating them like a long-term investment in the same way they would treat a productive business. But they are not the same thing. When you invest in productive business assets, there is an underlying engine creating value over time. Businesses can grow revenue, earn profits, innovate, and pay dividends. There is a reason for long-term expected returns. But something like gold, wheat, or oil, the investment return is much more dependent on what someone else will pay for it later. That does not automatically make it bad, it just makes it different. And if you are buying it without an existing risk that needs to be offset, in general, you are speculating on price movement. Now, to be clear, speculation is not automatically evil, but it should be called what it is. And when speculation becomes short-term, emotional, and disconnected from any real plan, that's when it starts to look a lot more like gambling and less like good decision making. So if I was to summarize all of this, I would say two things. First, the quarter was another reminder that markets can look rough in the short term and still recover quickly. And that's why reacting emotionally to headlines is typically a bad strategy. Second, when it comes to precious metals and commodities, language matters. Hedging is about reducing an existing risk. Investing is about owning productive assets over the long term. Speculation is about taking on extra risk in hopes of a profit from price movements. They are not the same thing, and mixing them up can have catastrophic consequences. Thanks for watching, and I'll see you in the next one.